Hello and welcome to Questioning the Manager. Today I'm joined by James Bunsen and Peter Webster, who are the co-managers for the Henderson Alternative Strategies Trust. James, Peter, thank you very much for joining me today. So to kick us off, I'd like you to give us your assessment of markets so far in 2018 and how the Trust has performed relative to its benchmarks and the current economic climate.
Well, 2018 really there's only been one game in town, and that's been US equities. Pretty much every other market is down year to date. So whether it's the UK, Japan, emerging markets in particular, having a pretty bad time. And also fixed income markets have been really at best flat, maybe up a little bit in high yield, but government bonds are down. So it's been a pretty tricky environment for most investors. And the reasons behind that poor performance, I think predominantly rising US interest rates and a much stronger dollar has put some stresses in places like emerging markets. Sterling weakness has offset some of that general market poor performance for sterling investors, but really it's been a difficult environment for investors year to date.
Yeah, given this difficult market environment, Haster's performed quite well. So the NAV total return year to date is 3.1%. We say that it's very strong in relation to the Trust AIC Flexible Investment Peer Group, where the Trust returns rank 7th out of the 18 strong peer group. As James said, this has been a very difficult market environment, and the fund's held up very well when we've seen market sell-offs, typically in late January, where we saw the benchmark fall 9.5% in total return terms. We actually saw the fund only fall 4.5%. On a share price basis, we have seen the discount of the fund widening out over the period, so the share price return actually negative 6.5% for the period, and this has lagged the US dominated index, which has returned 8.4% year to date.
And how does the Trust portfolio compare to the beginning of the year?
Sure, as we've discussed, so we found markets quite difficult this year, and we've reflected that in our portfolio positioning. So year to date, we've reduced our allocation to private equity. This fundamentally reflects our belief that listed markets have very high valuations currently, and this is a key component of valuing private investments. The reduction in our allocation to private equity has been offset by an increase in our allocation to property investments, where we've opened a new position in Urban Logistics REIT. This is a property investment company that focuses on industrial and logistics properties. We've also made some changes within the specialist sector area of the portfolio, where we continue to reduce our exposure to risky credit investments. At the same time, we have tactically invested in a basket of infrastructure names, which we believe now are fundamentally undervalued after having political headwinds and also some fallout from the Carillion collapse at the start of the year.
Now I'd like you to tell us, if you can, where you're finding opportunities in alternative markets and perhaps what your outlook is for the Trust for the next sort of 6 months or so.
Well, the Trust is very defensively positioned at the moment. As we alluded to, times are getting tougher for mainstream asset classes such as equities and bonds, and we expect that to continue. As well as interest rates going up, we now have the phenomenon of quantitative easing turning into quantitative tightening, which means we think liquidity is going to be withdrawn from markets, and it's just going to be much harder for things like equities to make further headway in that sort of environment. And then on the other hand, we've also got things like Trump's bellicosity when it comes to trade, and we see that persisting at least until the midterm elections in the US, which is at the beginning of November. So I think those two things in particular will mean a tricky environment for markets, and therefore we are much more positioned in hedge fund strategies which have more defensive characteristics because they can short stocks as well as go long. And then we've really repositioned the portfolio towards more idiosyncratic stories, so individual stocks or investment trusts that have their own catalyst, which we think will be realised in the next few weeks and months, which should generate some decent NAV performance for the Trust.
James, Peter, thank you very much for joining us today.